Welcome options traders. Hello everyone. I wanted to post this video as a follow-up to some of the previous videos I've done in the past week on trading edges and mostly talking about the concept of fair value. But there is a condition when a trading edge can actually backfire. And the reason is it's an apparent trading edge. And it looks like you have an edge, but depending on your trading strategies, you might actually be working against yourself. So let's take a look at when trading edges can backfire. As a recap, let's talk about the coin flip example. If I offer you the opportunity to win $1 here in green at the flip of a coin, you should be willing to pay me $1 every time that you lose here in red. Why? Because there's a 50% chance that you'll win and a 50% chance that you'll lose. It's even odds. No side really has an advantage, and therefore no side should really be paying more than the other. And so if we multiply these out, add them together, as I've shown in those videos, you get 0. And this is just a little mathematical trick, a little way to show what the long-term prospects are. So what this means, if we sat here for thousands and thousands of tries, neither one of us should expect to be up or down too much. We should expect to break even. So I showed a graph, and this is a computer simulation over 1,000 such trials. You can see 0 is right here. Is it possible to win or lose? Of course. You can see here early on, one side went up about $6 or $7. Then after about 100 flips, went down $16, $17, did the same thing after 200 flips. Then after 400 flips, this person went up maybe 11, 12 bucks. Did the same after about 800 flips over here. Went up to almost $15 here after 900 flips, and then after the 1,000th flip, ended up down about $7, $8. But the main point to see is that there is an overall sideways trend. There's no discernible up or down drift. That's a fairly valued bet. On the other hand, if you pay more than fair value, let's say you pay $1.20 every time that you lose in exchange for winning $1, then you're going to have a 20-cent edge working against you. And this is what your graph is going to look like. You'll have a long-term downward drift. There's no question about it. And can you win in the short run? Yeah, actually in this particular sequence, it looks like you might have been up just a few pennies right in here, but it didn't last long. And that will always be true when you have an edge working against you. On the other hand, what if you got the bet for less than fair value? Perhaps you were able to pay 80 cents when you lose, but you earned $1 every time you won. Now you've got the 20-cent edge working in your favor. And look at this. We end up with a long-term upward drift. It doesn't look like we lost here in the short run, although if we did this series multiple times, there would be some times you would be in the negative down here. But again, it wouldn't last long. You would always end up in the long run coming out of it and being on the positive side because you paid less than fair value. However, notice that that bet was set up in terms of dollars. I said you could earn $1 if you win, you'd have to pay $1 if you lose. What if we change the wording a little bit? What if I said every time it lands heads, I'm going to pay you 60% on your money, and every time that it lands tails, you will lose 40% on your money? It's just a different way of stating an edge. Do you have a long-term edge here? Well, most people would say, yeah, it's obvious. I've got a 20% edge. I just need to stay in this game as long as possible. Act like the casino. 24 hours a day, 7 days a week. Never stop. Keep trading, 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 and you're going to end up making money because you've got this edge. And in fact, we can see this by using the same fair value formula. Let's say if you have a 50% chance of winning 60% on your money and a 50% chance of losing 40% on your money, if we multiply those out, add them up, we get a net number of 10%. Now, some of you might be wondering, how come it's not 20%, the difference between 40 and 60? Well, remember, to get that 20%, it's taking 2 coin flips. So the average between those would be 10%. But still, do you have any idea how quickly your money would just compound out of control to billions of dollars if you had a true 10% edge? So there's a lot of services out there that talk about trading edges in terms of percents. And they'll say, yeah, you know, we do a lot of short-term trading. We win a lot and we lose a lot. In other words, probably close to 50-50, but we always win far more than we lose. And they might even throw out some numbers. We typically win 60% on our trades and we only lose 40%. And people go, aha, that's the magic bullet. I have this positive edge. Let me sign up for the service. And here's a couple of examples. Now, I've talked about these guys before in a previous video. I think it was titled, Can You Turn $10,000 into $1 million in 5 years? And that's their premise here. I guess that's why it's called Freedom 5, Financial Freedom in 5 years. And I showed in that video how you needed 151% per year to make this goal. And so they obviously must be compounding those returns. In other words, if you start out with a $10,000 account, you don't want to be placing a $500 option trade here and a $1,000 one over here. You need to take your $10,000, turn it into $12,000, take your $12,000 and multiply that out and keep compounding to even have any chance. Now, my goal here is not to necessarily pick on a particular firm. I'm just trying to show that there are a lot of companies out there that create these trading services, kind of these options challenges, and they charge you an arm and a leg to do it. So here's another one. And these guys have the $100,000 challenge, and I believe it's $3,000, maybe $5,000, but they try to do it in, I believe, 3 months or 6 months. It's a fairly short term to turn a relatively small amount of money into 100K. And you can even see right here, we put the odds in your favor. So if you listen to a lot of the marketing hype and the webinars, advertising materials, a lot of times they will actually show you numbers. And what I'm trying to show you is that you have to be careful about the way they're presenting the data. So what would actually happen if half the time you won 60% on your money and the other half you lost only 40%? Would you have a long-term edge? Well, here's a different Excel spreadsheet where I programmed it to do just that for 1,000 different trades, let's call it, or 1,000 different flips of the coin. And each time that you win, you're going to earn 60% on your money, and each time you lose, we're going to deduct 40%. And I'm going to start everybody out here with $1,000 in green. And after 1,000 tries, as shown by this graph over here, you can see, yeah, sometimes, look at this, got way up above $30,000 at one point. But if you sit there long enough, kind of strange, we ended up going to zero. Absolutely lost everything. Is it a fluke? Well, let's try it again. I'm going to hit the F9 key and recalculate it, and that just takes us into another 1,000 flips of the coin. And look at this. Wow, sometimes got up to $300,000 in here. But after a long term, we came right back down to zero. Let's try it again. Got some interesting large gains, about 55,000 here after maybe 60 flips or so. But if we sit there long enough, we ended up going to zero. And if we sat here long enough doing this over and over, you would see that that's the only outcome we would ever get. We're going to end up at zero. So how is that possible? We've got this apparent 10% edge working in our favor, but in the long run, we end up going to zero. Well, let's take a look at the numbers. Well, to make it simple, let's say we start everybody out here at $1 in green. If you increase that amount by 60%, you end up with $1.60. However, if you take your $1.60 and on the next flip you lose 40%, look at this, you're at 96 cents. In other words, you lost 4 cents across the two flips, even though there's a 10% edge. So an easier way to show that is if we take 1.60, that's what we would multiply your winnings by. Dollar times 1.6 would give us 1.60. But when you lose, we're going to multiply your money by 0.6, which is the same thing as subtracting 40%. You're just retaining 60% of your money. And if you multiply these out, 1.6 times 0.6, you get 0.96. So it doesn't matter how you cut it. After two flips, which is on average what's going to happen, you are retaining only 96% of your money, or in other words, you are losing 4% on your money across two flips. Now, I know that sometimes people will say this and say, yeah, but nobody was going to take 100% of their money and put it into the next bet. Well, and you're probably right. Wouldn't be the smartest thing to do. However, it doesn't change the math. You can say, I'm only going to invest 5% per try and whatever strategy you want to come up with. It doesn't change the fact that you're bleeding at the rate of 4%. It's like the old business school joke of the guy who sold everything at a loss but tried to make up for it in volume. It's not going to work. Yeah, it'll change the graph a little bit and it might drag out the inevitable a little bit longer, but you are still losing money at the rate of 4%. So the main idea here is that you have to be careful when you hear about a strategy that appears to have an edge, in percentage terms. So if you use that to compound your returns to try and get these super lofty goals in a short period of time, it's probably going to backfire. Now, are there times that it could work for you? It depends on the numbers that they're touting. So for example, maybe they say, let's start here at $1. We're going to win 60% whenever we win. Got $1.60, but we're only going to lose 30%. So we take our $1.60, we subtract 30% on that next flip, and we're still up $1.12. So in this case, yes, we would be compounding at 12% every 2 flips. That would be a good long-term deal. And by looking at the shortcut version, we could just say whenever you win, we're multiplying your money by 1.6, and when you lose, we're multiplying it by 0.7. Subtracting 30% is the same as retaining 70%. Multiply those together and we get 1.12. So that will compound in your favor. But once again, you have to question their assumptions if they're going to hold on for these really large gains and also have the ability to exit a potentially winning strategy, but to exit early to keep those losses small. I assure you their market timing is not that good, and that's probably not going to happen. So just be careful when you hear about some of these marketing firms touting strategies where they have a trading edge. But if you sign up for those services, you'll probably end up paying a lot of money only to watch your account slowly lose money. And for anyone interested in the art and science of options trading, please check out our free trading group on Facebook at Options A to Z.